As net income continues to fall on the farm, the U.S. Department of Agriculture expects the debt-to-asset ratio in 2017 will be the highest since 2002. In its first calendar year forecast released Tuesday, the agency projects U.S. net farm income will slide for the fourth year in a row and sit 9% lower than 2016. The mark of $62.3 billion would be nearly half the record farmers set in 2013. The USDA sees 2017 receipts from cattle and calves down about 7%, while those from wheat could plunge almost 17%. Cash receipts from corn and soybeans are both expected to be closer to 2016's numbers. Purdue University ag economist David Widmar joined us Wednesday to dissect the financial indicators. We started by asking for his thoughts on the net farm income prediction.
The USDA released its first look at 2017 yesterday, as they talked about the net farm income declining again for a fourth year. And it's important to keep in mind that this has been a big slide in net farm income. And when we go back to 2013, the decline is about 50% from the peak down to more than $62 billion in net farm income. So it's been a big adjustment in the rural ag economy.
Total farm debt, David, increased another 5%. Can you explain where that's coming from?
Yeah, so given the tight margins that producers are facing and the declining income, they're tapping into debt more. They're using more debt for operating lines of credit, for servicing or buying new equipment, replacing equipment, and land purchases as well. So this is part of the concerning trend that we see, declining income but rising debt. That's making it more difficult for producers to service debt. And so when we look at like ratios, like the debt service ratio, that trended higher with this latest results from the USDA.
That real estate debt, it's at a nominal high. Is that alarming at all?
Yeah, so when we look at real estate debt, it is at a nominal high. But when we look at this in inflation-adjusted terms, we haven't seen that really peak prior to the levels that we saw back in the 1970s or 1980s. So we see that growing. It is concerning given that we see net farm income declining, but it's important to keep that in mind relative to where we saw in inflation-adjusted values back in the 70s and 80s.
When you look at the level of debt to assets, is it at a level where it causes concern?
Yeah, debt to asset ratio is one of those most popular, I guess, cited ratios when we talk about the health of the U.S. farm sector. And it's actually a pretty difficult measure to keep in store. It's trended higher in 2017 based on the latest results. It's important to keep in mind we're at really low levels of debt, historically lows from the boom period. So we've got a lot of wiggle room before we get to those concerning levels. Like I mentioned earlier, it's really the debt service ratio that's more concerning right now than, say, debt to asset. But debt to asset's also tricky when we think about how few farmers use debt. I think the number is 1.4 million out of the 2.2 million farmers don't use debt. So this is kind of a tricky measure to really use as a true gauge of the health of the farm economy.
What level is alarming beyond that?
So back in the early 1980s, we hit a high of 22%. Of course, that's sector level. And when we look at the data, kind of back to the 1920s, we see that about 17% is the 75th percentile. So anytime we're below that 75th percentile, that means 75% of the data points were below 17%. Right now, we're just hitting that 25th percentile. So it's still on a historically low basis. But like I mentioned, it's a pretty tricky measure to really use just because so few farms actually have debt. We're actually concerned about the concentration of debt in some of the larger operations and high gross farm sales operators.